Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Friday, November 7th, 2025 trading session for the SPX CBOE index. We'll be using the Day Trading GPS SPX Daily Key Levels indicator for our entry signals and also for managing our trades. Specifically, we'll be using the V2.0 version of this indicator, which was just released a few weeks ago. Okay, so some of you may already be familiar with how this indicator works from seeing our other SPX trading videos on this YouTube channel. But for those of you who are not familiar with it, who may be seeing this video about this indicator for the first time, I'm going to briefly run through how the indicator works. However, this video is going to be a lot shorter than our normal videos, and there will be some topics that will not be covered in this video in as much detail as there are in other videos. So if you've never seen a video on this indicator before, I would invite you to look at some of the other session videos that we've done over the last 2 weeks or so. And in those videos, those are about an hour 15 to an hour 30 minutes long, and they go into a lot more detail about what each of the key levels represents, and also many other aspects about the indicator. So I would invite you to watch those in case there's certain things that you don't understand from this video. So we're trying to make our videos a little leaner and make them a little shorter than the typical ones, and try to keep them within 30 or 40 minutes or so from this point on. So again, if you've never seen a video on this indicator, please look at our other session videos. The links to those other session videos that you can look at that will be a more full description of how the indicator works are listed in the description of this video. Okay, so this indicator is for the TradingView platform only. All of our indicators that we sell are for the TradingView platform, including this SPX indicator. This SPX indicator works on two different SPX symbols on the TradingView platform. So one of those symbols is the SPX symbol that it is on now, which is the CBOE SPX index, and that is the official SPX index that everyone follows. So on TradingView, you would simply type in under symbol search SPX, and then you would look for the SPX symbol under the CBOE exchange. The indicator also works on a second symbol, which is the SPX 500 symbol, which I'll show you that chart now. Okay, so as you can see, SPX 500, and you would type in SPX 500 on your TradingView platform symbol search, and then you would look for that symbol under the 8-cap exchange. This is a Forex CFD version of SPX that trades in the overnight as well as the pre-market, whereas the CBOE SPX index does not trade in the overnight or in the pre-market, and this official CBOE SPX index opens at 9:30 a.m. Eastern New York time. Now, why does this indicator also work on this symbol as well for Forex CFDs? There are a couple of different reasons. One reason is even if you are trading SPX CBOE, and the main reason you would have it on that symbol is if you're using the core main strategy of this indicator, which we present in all of our videos, which is trading SPX index options. Now, why would you also have a chart open with this particular symbol as well, even if you're trading off of the SPX CBOE chart normally? The reason is because if you have it a second chart opened on this SPX 500 8-cap symbol, you can get the levels for CBOE SPX 30 minutes before the 9:30 a.m. Eastern New York time open. While on this SPX 500 symbol for 8-cap, it will at 9 a.m., which I've lined off here as when that occurred for today's session. So this is the 8:45 a.m. 15-minute candle here, and then this is the 9 a.m. So at 9 a.m. Eastern New York time, the indicator, while you have it on the SPX 500 8-cap symbol, will give you a chart that looks like this. So you'll have two tables on the chart, one which is the SPX 500 8-cap table here, and those are the same levels here that you'll see for this, and these are specifically for the SPX 500 8-cap CFD. Then this second table here is the additional table which displays the CBOE SPX key levels for today's session. So you can get these 30 minutes early via this table. It displays the bull bear key price level as well as the main R1 through R6 key levels and S1 through S6 key levels. So this allows you to get a 30-minute jump on the session that opens up at 9:30 and know what the key levels are for CBOE SPX. Now, the reason that these levels cannot be shown on CBOE SPX until 9:30 a.m. Eastern New York time is simply because of the way that TradingView Pine Script coding works. TradingView has a limitation in their system that if you have an indicator that is analyzing and generating levels for a specific symbol, even if your indicator knows what those levels are before that market opens, TradingView has a limitation that it cannot draw and display those levels on the chart while that market is closed, and it only will do so on the first tick. So on the first tick of the 9:30 a.m. Eastern New York time open, then you will see these levels on your CBOE SPX chart along with all the other levels. Now there are a couple of other reasons why you might want to have this indicator on the SPX 500 chart, and that is if you're not trading SPX index options and you are instead trading SPX through a Forex broker. So if you have a Forex account, then Forex is used typically for major currency pairs such as Euro USD, USD JPY, etc., and then also for CFDs for major indexes. So in the case of SPX, if you are trading through a Forex broker, you're not trading SPX index options, you are instead trading a Forex CFD, which is similar to trading futures, except in Forex, the way everything is done is a little bit different than the ES futures market. But the so if you have an account with a Forex broker, or if you are taking a trading challenge with a Forex-based trading challenge company, such as FTMO, Apex, or the 5%ers, or there's about 50 or 60 or so of those companies that are in the marketplace, that basically they will give you the ability to pay a fee to take a trading challenge. And if you pass that trading challenge on their platform, then they will give you a funded trading account in which you can use their risk capital up to a certain limitation that you qualify for whatever challenge that you passed, and then you can trade using their funds, and then you do a profit split with them. So if you're taking one of those trading challenges to a Forex-based broker, then you would use this indicator on this particular symbol to help you with that trading challenge. Alright, well now we'll go back to the main chart. Okay, we're back on the main CBOE SPX chart. As you can see, we're on a 2-minute chart. This indicator works on chart time frames of 1 minute up to 30 minutes. If you put it on a chart time frame that is longer than 30 minutes, there will be a disclaimer that comes up on your screen telling you that the indicator, you have, in order for it to work properly, you have to put it back in a chart time frame between 1 minute and 30 minutes. The main daily key levels trading strategy for trading SPX index options works primarily on chart time frames, or at least the recommended chart time frames rather, are 1 minute to 5 minutes. So those are the recommended time frames, somewhere between 1 minute and 5 minutes. So that would be either 1 minute, 2 minute, 3 minute, or a 5 minute chart. However, the recommended chart time frame out of that 1 minute to 5 minute zone of chart time frames would be the 2 minute. We have found that the 2 minute provides the most consistent results. However, if you prefer still trading off of another different time frame between 1 minute and 5 minute for this strategy, that is fine as well. Some people may be using this indicator along with some other indicators that they like, and they may prefer to use those other indicators on 5 minute or 3 minute or 1 minute. So but just keep in mind that all the videos that we show this core strategy on, we are always using the 2 minute chart time frame. So that is the most recommended chart time frame between 1 minute and 5 minute. Okay, so at 9:30 a.m. Eastern New York time, after analyzing the pre-market and overnight action, as well as current and recent market dynamics in SPX, along with current market volatility, the indicators algorithms, after analyzing all that, come up with the daily key levels for today's session. And they're displayed on your CBOE SPX chart at 9:30. Today, the main key level out of all the key levels given is this level here, the SPX Bull Bear Key Price Level, which is abbreviated KPL. We'll also be referring to this level as the BBKPL. This is the all-important Bull Bear pivot for this session. These levels are updated each trading day, so these levels are good for today's session only. So keep in mind that this indicator is for day trading only. What that means is that you'll be opening and closing your positions all in the same session. This is not a swing trading indicator. It is meant for a day trading only. So you're going to be, whatever positions you open up during this session, you will also be closing them during this session as well. You'll also see that there are other R levels and S levels above and below the bull bear key price level. So we have R1 through R6 and S1 through S6. As you can see here, we've drilled down between R3 and S4. So typically, even though the indicator will display by default R1 through R6 and S1 through S6, it's best when you're first using the indicator at the beginning of the session to drill down somewhere between R2 to S2 or R3 to S3, or in this case, we've opened it up all the way down to S4 as far as expanding it on our screen because of the bearish price action that we had today. And the reason for that is that so you can expand these levels out to drill down to see them more clearly when you're also looking at these midpoint and QL levels. Okay, so one thing with this indicator is that you can take bullish or bearish trades off of any of the main levels. What do we mean by what are the main levels with this particular indicator? Well, for purposes of the strategy, the main levels are the bull bear key price level and the main R1 through R6 levels above and the S1 through S6 levels below. The midpoint levels that you see and the QL levels that you see serve different purposes. So at the beginning of the session, most of your trades will be centered around the bull bear key price level, either at the opening 9:30 a.m. candle or during the opening moments of the session, which could be the first 5 minutes, the first 10 minutes, or even the first 30 minutes, just depending upon what type of volatility we're seeing and what type of average daily range that we're seeing with SPX. The R levels above the bull bear key price level are your take profit targets for bullish trades taken off and derived from the bull bear key price level. Your S levels below are the take profit targets for bearish trades taken from and derived from the bull bear key price level. These midpoint levels serve as standard stop losses. That is their main purpose at the initiation of a trade. The QL levels serve as tight stop losses for the initiation of a trade. The QL levels above and below can be turned on above and below any of the main R levels or S levels and also the bull bear key price level. On the startup default display of this indicator, the following key levels are displayed. Now, not all of these are displayed on startup, so this is why I'm explaining this. The bull bear key price level, the R1 through R6 levels and S1 through S6 levels, and then just 2 midpoint levels and 2 QL levels. So in the default startup look, you will have the first midpoint above the bull bear KPL, the first midpoint below the bull bear KPL, the QL above the BBKPL, and the QL below the BBKPL. All the other midpoints that you see that are turned on here were turned on manually and are not automatically enabled in startup. However, you can change the default display to your liking. So if you prefer a different look and feel on startup as far as what levels are displayed, you can customize that and set it as a new default if that's your preference. Also, you'll see these PMH, PML, YDC, YDL, and there's also YDH levels. Now the YDH level is out of range on this particular screenshot. What these levels stand for is this is the SPX pre-market high, the SPX pre-market low, the SPX yesterday's daily high, which is the previous day's RTH session high, the SPX yesterday's daily low, which is the previous day's RTH session low, then the SPX YDC, which is yesterday's daily close, the previous day's RTH session close. These levels are also very important for the context of the session itself. They also can have extreme importance where they occur in confluence with other key levels on the chart. One thing to keep in mind is that if there is going to be any significant rally, for example, then the rally is not only going to have to start closing above the bull-bear key price level, but it's also going to need to get over, generally speaking, any of these other levels that are above here. So if, for example, in today's session you have the YDL level and the YDC level, yesterday's daily close, yesterday's daily low, and the pre-market high. So in this case, for any significant rally, we're not only going to need to see closes above the bull-bear key price level, but we're also going to need to start to see closes and price staying above these additional levels as well, as they are important from yesterday's session as well as today's pre-market. The same thing in reverse for the bearish sell-off. For any significant bearish sell-off, we're going to need price not only to start closing below the bull-bear KPL level, but we're also going to need it to close below the PML pre-market low level and stay below the pre-market low level as well. These levels can also be very important levels to keep track of once you have a trade that goes in your favor that at least meets or exceeds a certain minimum level requirement for that type of trade, which we will talk about in a few moments. Okay, so going back to these midpoint levels. As you can see here, the midpoint levels are simply the mid-level points between main levels, such as mid R2, R3 between R2 and R3, mid R1, R2 between R1 and R2, mid S1, S2 between S1 and S2, mid BBKPL S1 between the BBKPL and S1, mid BBKPL R1 between R1 and the BBKPL. The midpoint levels can be turned on in your user control panel above and below each main level, as well as the QL levels being turned on above and below each main level. As I stated before, the midpoint level's primary purpose at the initiation of a trade is to serve as a standard stop loss level for trades taken from the applicable level. So for example, on a bullish trade taken from the bull-bear key price level, the midpoint level below it would serve as the standard stop loss for that bullish trade taken from this level. Conversely, on a bearish trade taken from the bull-bear key price level, this midpoint above is the standard stop loss for that trade. If, for example, we were taking a bearish trade off of the R1 level, then the midpoint above R1 would be your standard stop loss for that bearish trade. If we were taking a bullish trade off of the R1 level, then the midpoint below R1 would be our standard stop loss for that bullish trade. And the same thing on these S levels. If we were taking a bullish trade off of S2, then our standard stop loss is the midpoint below the mid S2, S3. If we were taking a bearish trade off of S2, then the standard stop loss is our midpoint above S2, mid S1, S2. For tight stop losses, the QL levels are used. So for a tight stop loss on a bearish trade from the bull bear key price level, the QL above is the tight stop loss. On a bullish trade from the bull bear key price level, the tight stop loss is the QL below. The QL above and below, the QL levels can be turned on above and below each of the main levels, and they serve as the same tight stop loss for a specific directional trade from those levels, just like they work here on this level. The reason you don't want to have them all turned on at the beginning of a session is because you want your display to be as uncluttered as possible. So as an example, as I stated before, on display startup, the default look is that only these two midpoint levels are turned on and only these two BBKPL levels. Only these two QL levels above and below the BBKPL rather. Other than that, it's just the main levels above and below. So any other levels, addition to that, as far as QL levels or midpoint levels, you would enable manually in the user control panel. You'll also see these two tables here. These tables are independently controlled. What that means is that you can independently move them to different parts of the chart by themselves, and you can also control the size of them independently. And you can also turn them on and off independently if you prefer just to have one of them on your chart, or both of them on your chart, or neither of them on your chart if you would prefer to save chart real estate, as you do have the line labels as well. All of the line labels are controlled by groups. For example, all of the main levels, the bull bear key price level, the R1 through R6, and S1 through S6 are a group. All of the midpoint levels are a group. All of the QL levels are a group. The PMH and PML levels are a group, and the YDC, YDL, and YDH levels are a group. What that means is you control them by group to either control the size of the display, meaning you can make these larger or smaller as a group, and you can also control the offset, moving them more to the left or right as a group. As you can see, I have all of the main level line labels, midpoint level line labels, and QL level line labels all on the same offset, so they line up. However, if you prefer a different look with some more to the left or right as a group, you can do that in the user control panel. And the same with the PMH, PML, YDH, and YDC levels. Those are controlled as groups, but as you can see, I have both of those groups also lined up on the same offset. Also, these labels, as you can see here, are the larger type. You can set them to tiny, small, normal, large, or huge. So these are set to large. The midpoints are currently set to normal, and the QL levels are set to small, and these levels are set to normal. They're all independently controlled by group, so if you prefer a different size than what is displayed normally on the default, then you can control those in the user control panel as well. Okay, so let's get into this specific session now. This is the 9:30 a.m. opening candle for Friday's session. As you can see here, it looks like it opens right at the bull bear key price level. It actually opens about 10 cents or so above it, which may be a little difficult to see on this particular screen, but that is the case. It does open slightly above it and then sells off below it and closes below it. If trading the 9:30 a.m. opening candle, this is your bearish signal. Now, if you have seen our other videos, you will know that in our other videos, we are always trading the 9:30 a.m. opening candle. There are exceptions to that. First off, the 9:30 a.m. opening candle, even though it is part of the strategy, it is an optional part of the strategy, as there is no rule or obligation that you have to take the opening 9:30 a.m. candle trade. And if it is your preference, you can instead wait for price action to play out to a certain point in the session, whatever preference that is for you, whether it's waiting out the first 5 minutes, the first 10 minutes, 15 minutes, 30 minutes, the first hour, or even a couple of hours. That is up to you as a trader to decide. Some people prefer to let the opening range play out, whether they define the opening range as the first 5 minutes, the first 15 minutes, 30 minutes, or an hour. So some people prefer to let price action breathe a little bit and then decide which of the key levels they prefer to take their trade on for the particular session. So the point that I'm trying to make is that the 9:30 a.m. opening candle trade is part of the strategy. However, it is an optional part of the strategy. It's not an obligated or rule that you have to take the opening 9:30 a.m. candle, which on a 2-minute chart would be the candle opening at the 9:30 open and it closes at 9:32. Now there are exceptions that even if you normally take the 9:30 a.m. candle trade, there are exceptions and occurrences where you would not take the 9:30 a.m. opening trade even if it closes above or below the bull bear key price level, and that has to do specifically with where it falls in a certain range above or below where it closes above or below the bull bear key price level. And we have a specific video on that, which remember from the preview to this video, there is a link in the description of this video which will take you to a Google document that will have lots of different videos on other topics concerning the use of this indicator, which go into more detail about a certain topic, and that's the only thing that that's discussed in those specific videos. So if you go click on that link for that that goes to that document in the Google Drive, which displays the links and descriptions for those videos, you'll find one of those videos goes over as a discussion about 9:30 a.m. candles to avoid, and there's also an accompanying PDF document that also goes along with that particular video that you can also click on. So I would invite you that to look at that, look at all the descriptions of the different topics from that Google link, and take a look at that video that is part of the series of videos that are displayed there. We're not going to go into that particular topic today, but just know that there are instances at which that even if you have a close above or below the opening, a close above or below the bull bear key price level on the opening 9:30 a.m. candle, there are exceptions to it. Those exceptions happen maybe somewhere between 5, 6, maybe as up to perhaps 10 times a year out of the 250 to 255 or so trading sessions for SPX that we have a year. So it doesn't occur that often, but if you do trade the 9:30 a.m. Candle consistently, then there's definitely something that you need to be aware of and know when to avoid that if you normally take that trade. But as you see in our videos, except when those exceptions occur, we do employ that option of the strategy and do take that trade, such as today. So in today's, we have a cross below and close below. Now in the case of a bearish trade, this could have opened above or above here and closed below, or let's in this case more above here and closed below. It also could have just opened below, stayed below, and closed below. So the main thing is where is it closing, not where it's opening. So in this case, we have it opened slightly above, crossed below, and closed below, and it's still within the acceptable range. Conversely, if this had opened down here and crossed above and closed above, or if it had opened above, stayed above, and closed above, the main point being closed above, then instead the opening candle trade, if you would take that trade, is a bullish trade. In this case, it is a bearish trade. Now, okay, it's a bearish trade. Now, what are the options that we utilize on this bearish trade that's from the bull bear key price level? That is 66.9608. When you take a trade off of any of the main key levels, whether it's the bull bear KPL level or it's one of the main R or S levels, whether it's a bullish or bearish trade taken off any of those main levels, there are always going to be 3 different option strikes that you can utilize. And those depend on the level that you're trading from, as well as whether it is a bullish or bearish trade. One is the standard play is going to be an at the money strike closest to the price of the level that you're trading. And then there are 2 out of the money strikes that you can also consider that are based on the direction that you're trading. There's a specific process for determining the out of the money strikes. There's also a video specifically on this topic that's also included in that list of videos per the link that I described earlier. That's in the description of this video. But we will go over it today for the specific trade in hand. So with this one, the bull bear key price level is 66.9608. So the standard play with this daily key level strategy is that you are going to use an at the money SPX 0 DTE option that is closest to the strike closest to the level that we're trading, in this case the bull bear KPL, and that would be the 66.95 strike. Since this is a bearish entry signal, then it will be a put option. So the 66.95 put is the closest strike, and you are buying it on the candle close, mainly because we want to make sure where exactly it's going to close. If you bought it intra-candle and this ended up closing above and you're buying it down here intra-candle, a put, but yet it closes above, then you have a problem. So it's best to wait for the candle close so we know which directional bias that we're going to have on this opening candle. Now, one thing to keep in mind is that with this indicator and with this strategy, the primary options are going to be 0 DTE options. However, if you prefer, you can also use 1 DTE options. So for example, for today's session, Friday, November 7th, if you were using 1 DTE, then you would use Monday's options. But if it's 0 DTE, then you're using the options that expire today, November 7th. You don't want to use anything more than 1 DTE because, as we stated early on in the video, you are opening and closing these positions all in the same session. So if you're using something that's more than 1 DTE, then you're going to be paying a lot more, and it's not going to help you at all because of the fact that you're going to be opening and closing in the same session. The 1 DTE options can be helpful if you happen to hold positions until very late in the session. So those will have less time decay on them than what you would see in the 0 DTEs, and they can be useful, and we have some session videos that we've made where we've shown the difference between 1 DTE and 0 DTE of what happens at the end of the session and the pros and cons of using either one. And then we also went in that particular session through the differences in prices as far as entry between 0 DTE and 1 DTE, as well as how those profits were different on 0 DTE and 1 DTE throughout the session as it hit the targets. So you may also want to check out that video if that is of interest to you as far as determining whether 0 DTE or 1 DTE would be better for you. Okay, so the candle close for the 66.95 put is 28.10. If you're not familiar with how options work, the cost of buying one option, you take the price that you're paying, you multiply it times 100, that's your cost. So in this case, the cost of one put option is going to be $2,810. Now normally this put would probably be a lot less expensive than this. However, we have increased implied volatility today due to recent events and another gap down today. So the IV is a lot higher, so the prices of all the options are going to be higher than they have been in the recent couple of weeks. If, for example, this price of this option was $25, then you'd be paying $2,500 for one option. If you're buying multiple options, then you would simply multiply that figure times however many you're buying. So for example, if you bought 2 options, it's going to be 2 times $2,810. If you bought 10 of them, then it's going to be $28,100 as an example. Now what about stop losses? Well, we went over that before. It's basically you take the level that you're trading. What's the direction we're trading? We're trading down. This is a bearish entry, so we're looking down. So our stop losses are going to be above the level that we're trading. Our two choices are, on any given level, the tight stop loss on a bearish trade from any level is going to be the QL above that level. So in this case, since it's the bull bear KPL, our tight stop loss is the QL above the BBKPL, 6,747. Your standard stop loss is going on a bearish trade is going to be the first midpoint level above the level that your main level that you're trading. In this case, the bull bear KPL, so our standard stop loss is this level, mid BBKPL R1, 6704.86. The stop losses on this trade are going to be the same whether you use the at the money standard play strike or you use either one of the out of the money strikes, which we'll explain now how you arrive at which ones those can be. So on the out of the money strikes, this works the same on any main level trade. You basically have the level that you're trading from. What's the direction? Bearish, so down. The two different option strikes are determined by the direction that you're trading from the level that you're trading and then it's determined by the midpoint level and the next main level. So in this case, since it's a bearish trade, the first midpoint level in the direction is 66.8730. The closest strike to that is the 66.85 put option. The furthest out of the money that you can consider for this particular bearish trade is the closest strike to one level away in the direction that you're trading, in this case bearish, so that would be down, S1 66.7852. Now in this case, the closest strike is the 66.80, because this is over the midpoint between 66.75 and 66.80. So since it's over the midpoint between those two strikes, you defer to the one that it's closest to, in this case the 66.80. The 66.85 put option on this candle close was $23.10. The 66.80 put option on the candle close was $20.90. So keep in mind that if instead this had been a bullish trade, this had closed above, we were taking the 9:30 a.m. opening candle trade, it closed above, well, our at the money standard play would still be the same because it's based on this level. So in that case, we'd be using a 66.95 call, and then for the out of money strikes to consider on a bullish trade from this level, we would simply look above to the half level here, 67.0486, so it would be the 67.05 call. The next level we would look up is one level above, that's the furthest out of the money we can consider, 67.1364, so that would be the 67.15 call. And it basically works the same off bullish and bearish trades from any other main level as far as determining the out of the money and at the money strikes. Now, what about profit targets? Profit targets and adjustments depend on what type of trade that you're doing using this core daily key level strategy. There are two different types of trades that you can use with this daily key level strategy. One is a scalp only trade. The other is called a regular trade. A scalp only trade requires a one level move for an exit. So that is a one level move in your favor. The one level is calculated by the level that you're trading from, in this case the bull bear KPL, and the direction that you're trading. This is bearish, so we're trading down. One full level down from the bull bear KPL is S1. So S1 is your target exit for a scalp. On scalp trades, they are 100% closeout only. There's no stop loss adjustments, and you are closing out all of your contracts regardless if you're trading multiple contracts or just one contract. So whether you're trading just one contract, two contracts, three contracts, 5, 10, 20 or more, if your objective is a scalp only and you're doing a scalp only trade, then when it reaches your target, then you are exiting the trade. Once you've exited that scalp trade, then you're free to look for other trade opportunities throughout the rest of the session, because now you've exited your initial position, and if you are going to be trading the rest of the session, now you can look for an additional trade entry for either a scalp or a regular trade. A regular trade is different from a scalp in that it requires a minimum 1.5 level move in your favor. So a 1.5 level move in your favor is determined the same way as we did the scalp, except it's another half level. So what's the level we're trading from? What's the direction down? That's one level. This is 1.5 levels. The S2 would be 2 levels. The mid S2, S3 is 2.5. the S3 is 3, the mid S3, S4 is 3.5, and the S4 is 4, because we're calculating that from the level that we're trading and the direction that we're trading. If it was a bullish trade, it would be the exact opposite. A scalp would be the R1 if we're taking a bullish trade from this level. A regular trade would be mid R1, R2, minimum required 1.5 level move. R2 would be a 2-level move. This would be a 2.5 level move, and this would be a 3-level move. If you were taking a bullish trade off of R1, then R2 is your scalp exit. If you're taking a bullish trade from R2, then R3 is your scalp exit. If you're taking a bearish trade off of R2, then R1 is your scalp exit, and the mid BBKPL R1 is your minimum required 1.5 level move. If you were taking a bullish trade off of S1, a scalp would be a 1-level move up to the BBKPL, whereas a regular trade would be 1.5 levels, mid BBKPL R1. If you were taking a bearish trade from S2, then S3 is your scalp trade, and then this mid S3, S4 would be 1.5 levels down on a bearish trade from S2. At 10:06 a.m., this trade hits the, well, let me go through this first, excuse me. All right, so at 9:36 a.m., as you can see here on this candle, this is a big candle. This is a 2-minute candle, keep in mind. And it not only hits S1, which is our scalp exit, it also hits the mid S1, S2 level, which is our regular trade, minimum required 1.5 level move. On the candle close of this candle, the 66.95 put is $39.30, so that's a $1,120 profit per option. The 66.85 put is $33.09, $999 profit per option. The 66.80 put is $30.30, that's $940 profit per option. Now in this particular candle, it happens to hit both the scalp level and the 1.5 level move, minimum required move for a regular trade. So on a scalp, you would just be closing out your contracts. However, since it also hit the regular trade level, when you have your minimum required target hit on a regular trade, you have these options. Either 100% close out all of your contracts, regardless of how many that is, or adjust your stop loss on all contracts, however many that is, to break even. What that means at this point is that initially your stop loss is based on a level. So remember, our stop losses were these levels here on the initial trade. There are a couple of brokers that do allow and do have a feature that will allow you to place a stop loss on options based on the price of the underlying. So in this case, the price of what SPX is. Normally, with most or virtually every broker, they allow you to place a stop loss on options only based on the price of the option, typically. However, there are a few brokers, such as Thinkorswim, which is now owned by Charles Schwab. It used to be owned by TD Ameritrade. Also, Interactive Brokers is another broker that allows stop losses on options based on the price of the underlying, or you can set a price based on the price of the option. However, with this strategy, your initial stop loss is based on levels. However, if you do a stop loss adjustment to break even, or break even plus a profit buffer, at that time when it hits the minimum required 1.5 level move, at that time you're no longer going to do your stop loss by levels. You are instead just switching to the standard stop loss by price, and then you would move your stop loss to either to break even, the price that you paid, or break even plus a 10 to 15% profit buffer. What that means is you add 10% onto this. So as an example, we would add $2.80 onto this, which would basically be $30.90, or you can round it off to 31. Or you would add 10 to 15% to this number, or 10 to 15% to this number, or you would just move it to break even, which is 28.10, 23.10, or 20.90 if you don't want to do the profit buffer. Then, if price continues to move in your favor and you're not stopped out, then at each succeeding level move in your favor, you add an additional profit buffer onto your whatever contracts you have remaining, or you close out. So at each succeeding level, you have the same basic decisions to make and the same options that you have as price continues to move in your favor and hits another succeeding level in your favor. So at this point, on a scalp, you've closed out. On a 1.5 level minimum required move, which was also met in this candle, then you would do one of these options here. There's also an additional option if you're trading multiple contracts, where you can close out 70 to 90% of those contracts, meaning you're closing them out at this price on this candle close, 70 to 90% of your multiple contracts, and then you are adjusting your stop loss to break even, or break even plus the initial 10 to 15% profit buffer on top of break even on the remaining contracts, which are known as runners. Then on those contracts that you have as remaining runners, then at each level move, continuing move in your favor, you would either close out those runners at the next level move in your favor, or you would adjust the stop loss. Or if you adjusted this, if you did not close them out 100% and you kept all of your contracts and simply adjusted the stop loss, then on each succeeding level move in your favor, you go through the same decision-making scenario again. So if you adjusted your stop loss here and then you were waiting for price to hit the next level in your favor and you did not get stopped out, then at that point when it hits the S2, a 2-level move in your favor, then you go through the same decision process here. Am I going to close out? Am I going to add on an additional profit buffer? Or am I going to scale out and do an adjustment? And then as it hits each succeeding level in your favor, in this case that would be below since it's bearish, then you would have the same decisions to make. Whereas on a scalp, you're simply closing out on a 1-level move in your favor. And then if you're still trading the rest of the day, then you are deciding if you're going to enter into another trade off any of the main R or S levels, or BBKPL if that comes back into play later in the session. Okay, so at 10:06 it hits the S2 level. That's a 2-level move in your favor. This is known as the ideal 2-level move for a regular trade. What does ideal level move mean versus the minimum required 1.5 level move? The minimum 1.5 level move is the minimum required to do one of these options. So that minimum 1.5 level move triggers one of these options. The 2-level move also triggers these options. However, the difference is that on 80% or so of the sessions that you'll have with normal volatility, so keep in mind this is with normal volatility, a 2-level move is typically going to be the max extent of most moves in a normal volatility or lower volatility environment with SPX. So a minimum ideal move is a good place to close out 100% of your contracts or any remaining runners, in most cases, on normal to lower volatility days. However, on higher volatility days, we can see extended moves that can go to 3-level moves, 4-level moves, 5-level moves, or even 6-level moves. This indicator also allows you, this V2.0 indicator, allows you to enable up to 10 levels above and below. So only 6 levels above and below are turned on by default. However, if we start having very extreme volatility days, you can also turn on R7 through R10 and S7 through S10 to accommodate those extreme volatility days. Those may happen where it exceeds S6 or R6 a couple of times a year normally. However, there are periods of time in the past, such as the COVID pandemic and other times where we had the financial crisis with Lehman Brothers, and other times in the past where we have had days or weeks or longer periods of time where we've experienced extreme volatility for a substantial period of time. So if that happens again in the future, or we happen to be involved in a day that is one of those exception days that happens maybe a few times a year, you can simply turn on the additional levels to accommodate the extreme volatility. Alright, so when it hits this S2 level, the 66.95 put is $40.69. That's $1,259 profit per option. That's on the candle close. As you can see here, there was a wick below, so without the candle close, if it backed off, so actually you could have gotten more out of this if you wanted to get it at the height or the low of this wick. But these are off of the candle closes. The 66.85 put was $35. That's $1,190 profit per option. The 66.80 put was $31.30. That's $1,040 profit per option. At 11:14 here, it hits the mid S2, S3 level. That's a 2.5 level move. 1 level, 1.5 level, 2 levels, 2.5 levels. The 66.95 put is $53.40 on this candle close. That's $2,530 profit per option. The 66.85 put is $45.27. That is $2,217 profit per option. And the 66.80 put is $41.09. That's $2,019 profit per option. Okay, so now at this time we're going to take a look at the Thinkorswim charts quickly, run through those quickly, and that will be the end of this video. First, the 66.95 put option. Here is the 9:30 a.m. This is a 2-minute chart of that option, same as we're trading from 2-minute chart. Okay, so the 9:30 a.m. candle close, $28.10. That's on the entry close below the BBKPL. Here's the 9:36 a.m. candle that hits both S1 and then mid S1, S2. The close $39.30. Here is the 10:06 a.m. candle that hits S2, $40.69. Here is the high, $42.88. As I said, there was a wick that could have given you a little bit better price if you got out on that wick. Here's the 11:14 a.m. candle that hits mid S2, S3, $53.40. Next, we'll take a look at the 66.80. That's the furthest out of the money. 9:30 a.m. candle close below the BBKPL. Entry $20.09. $20.90 on the close. 9:36 a.m. when it hits S1 and the S1, S2. The close $30.30. 10:06 when it hits S2. $31.30. 11:14 when it hits mid S2, S3. $41.09. Finally, the 66.85. 9:30 a.m. candle close, $23.10. 9:36 a.m. candle hitting S1 and mid S1 S2, 33.09. S2 hit at 10:06 candle, on the close, $35. 11:14 a.m. hitting mid S2 S3, close 45.27. Okay, so now we'll just go back to the main chart and wrap up this video. So as we mentioned at the beginning of this video, if you do have an interest in purchasing this indicator, in return for you taking your time to watch this video today, you can email us at daytradinggps@gmail.com to request a promo code for the SPX Daily Key Levels indicator. And if you send us that email, then we will send you a discount promo code that's good for a substantial discount off of the regular purchase price. All of our indicators are sold on a one payment for lifetime access basis. That means that you make one payment, then you have lifetime access, and when we come out with new versions of the indicator that have enhanced features or additional features in the future, or we have any updates to any of the to this indicator, then you will get any updates as well as any new versions with enhanced features at no additional charge. With each version release of this indicator, the price will be going up at each time there's a new version release, and there will be a new version release very soon on this indicator. That will be version 3.0. that will have some new additional features added to it, and at that time the price will be going up substantially from the price it is the regular price now. So if you do purchase it now, you will also be able to apply the discount promo code to today's lesser regular price. You'll be able to apply that promo code to the current price before it goes up with the newest release. And then once the new release comes out, you will also get that version at no additional charge. And then if we come out with any additional versions or updates in the future, you will also receive those at no additional charge. So again, thank you for watching this video. If you did like the video, please click the like button, as it helps us with the YouTube algorithm. And if you'd like to be notified when we come out with other videos, we do make other videos besides session videos on different specific topics concerning this indicator and our other indicators. So if you'd like to be notified when those come out, you can subscribe to the channel, and then you'll be notified once those are posted. So thank you for watching today's video. Hope you have a good weekend, and we wish you much prosperity in your future trading. Thank you.